Let's discuss the rewards of diversified portfolio investing. Here we show 45 years of risk and return data for 7 different asset classes. What's interesting about 45 years is over the last 45 years, we had periods of rising rates and periods of falling rates, periods where U.S. stocks were increasing and periods where they were decreasing, periods where commodities were booming and commodities were busting. Now, if you're like most U.S. investors, you're really wrestling with the trade-off between low risk, low return U.S. bonds and high risk, high return U.S. stocks. And when you see this page, you will likely want to cross off commodities and gold because they have high risk and low return. And when you look at international stocks and real estate, you can pretty much cross them off because U.S. stocks had higher returns with lower risk. And international bonds, this button right here is a little bit interesting, but it's between U.S. stocks and U.S. bonds. So you're still left with the trade-off between U.S. bonds and U.S. stocks. The purpose of this presentation is to think about what if we didn't want to make that trade-off? What if instead we owned the entire world and were properly diversified? Well, that equally weighted portfolio defied the commonly held beliefs concerning risk and return. It would have had returns almost as high as U.S. stocks with risk lower than the 10-year U.S. government bond. Pretty amazing. Here we show the numbers behind that graph. Average annual returns, that diversified portfolio had the second highest average annual return. Standard deviation, this is what Wall Street uses as a proxy for risk. Being diversified would have had the lowest risk. And here on the right, we show the Sharpe ratio, which is essentially the bang for the buck you got in terms of how much extra return did you get for each unit of risk you took. And when you combine high returns and low risk, you get off the charts Sharpe ratios. Here we show the 5 worst calendar years out of the last 45 years. So let's start on the left with U.S. stocks. What was the worst calendar year out of the last 45 years? 2008, down 36%. But of course, there was also a down 25, a down 21, a down 14, a down 11. And although this chart doesn't show it, there was a down 9, a down 4, etc. Many down years over the last 45 years for U.S. stocks. What about U.S. bonds? The worst year out of the last 45 years was down 11%, but this is not 2008. There was also, of course, a down 9, a down 8, etc. Many down years for U.S. bonds. International stocks and bonds, many down years in the last 45 years. Real estate, gold, and commodities, many down years in the last 45 years. How about all the way on the right, the diversified portfolio would have only had 4 losing years out of 45 years. So why do we want to be diversified? Because we want steady returns. Here we show the percent of calendar year returns between 2 ranges. The first range is between 0 and 15%. The second range, we widen it to be between down 5 and up 25%. And we can see how often that diversified portfolio fell in those ranges, as well as how often the S&P 500 did. And then we introduced this 70-30 portfolio, which is what I see as the typical U.S. biased 70% U.S. stock, 30% U.S. bond portfolio, what most investors are accessing to provide diversity and consistent returns. What we could see is being diversified was much more consistent than these other 2 options. Here we show a visual analysis of calendar year returns. So for the S&P 500, we have 45 different lines here, one for each of the last 45 calendar years. What's interesting to note is that although we learned that the S&P 500 averages 10% per year, in any given calendar year, the returns were anything but 10%. Could have been between up 37% and down 37%. You really didn't know. The diversified portfolio was much different. If we exclude this outlier great year, and if we exclude this outlier down year, the calendar year returns for the diversified portfolio fell into a much tighter range of outcomes. We were much more certain of what our returns would be. Here is absolutely the best thing we can show you, rolling 10-year data points. We've shown you a 45-year data set, which is likely too long for most investors, and we've shown you individual calendar year returns, which are much likely too short. But here we show rolling 10-year data periods. The first one starts at 1970 and goes to 1979. The second one starts at 1971 and goes through 1980. There was, of course, a 10-year data period starting in 1983, going to 1992, etc. There are 36 rolling 10-year data points here. Now, let's look at the S&P 500 average year. What we saw earlier was that the S&P 500 averaged 10% per year with a risk of 17%, and this is what most investors think they're going to get going forward. What we can see is that in any 10-year period, U.S. equity investors either did much better than average with even less risk, or much worse than average with even more risk. What's so interesting about this grouping right here is it looks a lot like commodities. The difference between doing really well in US stocks and really poorly over a 10-year period is, did you run into a bear market or not? If you did not, you were likely very happy with your returns. If you ran into a bear market, you likely did very poorly. Now let's look at that 70-30 portfolio. What's interesting is that we can draw a rectangle around those rolling 10-year periods. The risk was very well defined for that US 70-30 portfolio between 10 and 15%. What's not defined is the average annual returns. You could have either done very poorly over a 10-year period or done very well. You really did not know. But then we look at that diversified portfolio, and it was very highly concentrated in the upper left-hand quadrant, low risk and high returns. What's also interesting is that that average year for the diversified portfolio fell right in the middle of all the rolling 10-year periods. You pretty much got what you thought you were getting if you were diversified. Here's another version of do you want steady returns, but this is rolling 10-year data. And what I find is most interesting is looking at the lowest rolling 10-year periods. If you were diversified, the absolute worst 10-year period you got was averaging 6.5% per year for 10 years. Not too bad. If you were in the S&P 500 or the 70-30 portfolio, you could have experienced decades with very poor returns. Now, if you are trying to withdraw money to fund your retirement, and these are your average annual returns, 10 years later, you are likely very disappointed. Even with poor timing, that diversified investor fared rather well. Here's another visual analysis, but it's rolling 10-year returns. So here we have the S&P 500 10-year returns. You could roll some dice. Did you get very unlucky for a 10-year period, or did you get lucky? You really do not know. If you were diversified, you had a much tighter range of outcomes, and luck did not play very much of a role. Here we show the growth of $100. So in 1970, if you put $100 in the US stock market or $100 in the diversified portfolio, what would have happened over the next 45 years? You can see they roughly mirror each other. US stocks experienced more periods of euphoria and depression, but over the long term, they sort of tracked each other. So the question is, did you even need to be diversified? And I would ask, does valuation matter? Here we show a Shiller PE chart. Robert Shiller won a Nobel Prize. PE stands for price earnings ratio. This is one metric for evaluating how expensive US stocks are. Here's where we are today. What's interesting is that in more than 100 years of data, US stocks have only been this expensive 3 times. Right before the Great Depression, during the internet bubble, and right before the 2008 crash. Now, this does not mean that we are about to experience a crash. What it does mean is this is where we are, and we are making investment decisions for the future. What if we woke up here, or here? What would our portfolios have done going forward? What has happened after these levels? This is how you read this chart. 5 years after the 2007 peak. So at the 2007 peak, if you put $100 in the diversified portfolio, 5 years later, it would have grown to $136, averaging 6% per year. US stocks would have only averaged about 1% per year, and that 70-30 portfolio would have only averaged about 4% per year. The difference between being diversified and that 70-30 portfolio is about 10% to your net worth in just 5 years. Not a game changer, but I would have preferred to be diversified. But it gets interesting when we go down to the middle rectangle. 5 years after the 99 peak, if you put $100 in the diversified portfolio, would have grown to $150. 5 years later, US stocks were still down, and that 70-30 portfolio would have only grown to $107. Being diversified would have added more than 30% to your net worth in just 5 years. I call that a game changer. Let's go down to the bottom rectangle. 5 years after the 1929 peak. I call this one depressing. I guess that's why they called it the Great Depression. 5 years later, that diversified portfolio would have fallen to $96. US stocks and that 70-30 portfolio both got crushed. What's interesting to note is that in a little event called the Great Depression, being diversified would have preserved the value of your assets. This would have been a game changer. Here's the final slide, and this is where we take out our crystal ball and show you risk-return data for the next 45 years from 2015 to 2060. Unfortunately, I'm joking, we do not have a crystal ball, as all the return data, all the risk data, and all the asset class data are unknown. What we mean by this chart is that going forward, we think there will be things in the world to invest in that have higher risk, higher return, and things which have lower risk, lower return. Unfortunately, we don't know what those things are, what the returns will be, or what the the risks will be, but based on history, we believe that if we sensibly diversify, we can have a higher return than most things and a lower risk than most things. Our lawyers hope that you are good at speed reading. Please do reach out to us for more information.